Very excited to talk about this first panel. It's on auto financing markets' effect on industry stakeholders and the economy. And do a quick introduction, and we'll have a few questions, and then we'll turn it over to the audience for questions. Nick Clements has worked in consumer banking for nearly 15 years before co-creating Magnify Money. He ran the UK consumer business for Barclaycard. Prior to that, he spent most of his career at Citigroup in risk management. A graduate of Stanford University, he studied economics and history, and he recently did a great conference call with us. We're very happy to have Nick here. Rebecca Lindland is the Senior Director for Commercial Insights at Kelley Blue Book. She previously worked as Senior Research Fellow in Transportation at CAPSAR, is that right?
Kingdom Petroleum Studies and Research Center in Saudi Arabia.
Okay, there we go. I knew I was
right off the tongue.
I knew I was not going to get that.
I
Okay.
didn't work for the king, though, just to clarify that.
And Director of Research at IHS Automotive. Rebecca also spent 3 years as a member of the National Research Council at the National Academies. And John Van Alst is a staff attorney at the National Consumer Law Center, whose focus includes deceptive practices law, automobile fraud, rural issues, warranty, and manufactured home issues. Prior to joining NCLC, John was an attorney with Legal Aid of North Carolina. He was also the chair of the North Carolina Consumer Law Task Force. Thank you all for coming today. And I'd like to first kick things off. And Nick and I were just talking about this, and hopefully it's something we can all talk about. But what is, maybe we could get a picture of what you all are seeing happening in this market right now. That might be an interesting place to start. Are we seeing signs that this market is fragile, that defaults are going up, that because customers are having a hard time repaying? What are we seeing? You all have very interesting perspectives. What are we seeing on the ground right now? And maybe start with Nick, just because I know we were just talking about this.
Sure. So I think I'd go with it two ways. There's leading indicators. So do we have an underwriting system in place which sets off alarms? And I'd say yes, and I'll walk through a consumer survey that we did that says there are a lot of alarms being set off. And then there's the lagging indicators, which is delinquencies and defaults. And in an industry where you have very rapid growth, you really shouldn't see a lot of industry level default numbers going up, because when you're booking so much volume, it's numerator denominator, you should be seeing sort of relatively at a minimum stable defaults. But if you then look inside of some of the securitization trusts and some of the data of subprime originators, there are defaults there at particularly high levels. But let's start with leading indicators, if I just go very quickly through this. If you imagine sort of that theoretical bank where you walk in, there's a bank branch employee sitting, they're paid basically a fixed salary, maybe some bonus, small, but tied to the long-term health of the institution, and then they issue loans using bank deposits, and it sits on their balance sheet until the end. That's sort of a nice little mythical world that used to be banking. You can understand how the interests are aligned, that that institution will only want to make loans where the consumer pays that loan back. Now let's imagine a world of auto lending where, first of all, the dealer plays a huge role, right? So when we did our survey, 64% of all people let the dealer find them a loan. So I know we talk about banking, we talk about lenders, but the dealer is at the center of this and is also largely unregulated from a financial perspective. So the dealer is at the center, and 64% of people go to the dealer to shop. And I tried to help my mom out when she was buying a car. I was a head of a Barclaycard, I was a chief risk officer. By the end, I was almost ready to buy the warranty. I was so tired. Right? This is a high pressure environment when you sit in that dark room in the back with the dealer finance person. So warning, red flag number one is the origination being done by a third party who has no skin in the game, or by the lender itself. And big red flag number one is the majority of loans are being are being originated by people who have absolutely no skin in the game, and in fact, worse, right, all they care about is biggest loan possible incentives being paid, right? They work for the auto dealership. The bigger the loan, the bigger the sales volume, because they make the money on the car and they make the money on the financing. So that's red flag number one. Red flag number two on leading indicators is verification, right? So if you think about the ninja loans of subprime, no income, no job, no assets, right? It's really not that hard to figure out if someone has a job, has income, has assets. It just can't happen right away. And if you think of it, again, dealer central to all of this, the job of a good car salesperson is don't let them walk off the lot without a car, right? If you think about what is that dealer, to the person working on the lot told, do not let them walk off the lot without a car. Now, if that's the requirement, it's kind of hard to verify things. Now, think about the way the banks and the lenders have to deal with the auto dealers, right? The auto dealers, right, are basically saying to the banks, if you make it easy for me to book a car loan, you will get the volume. If you put obstacles in my way, I will just go to lender number 2, 3, 4, or 5. So it is a race to the bottom from the lenders in terms of the verification requirements. And so what ends up happening is, again, in our survey, over half of people who borrow for an auto loan have no income verified. So that's big warning number 2. And if you think about now what happens if we put those two things together, and this is where I make it human, you work at the dealer finance lot, you're at the lot in the dealer finance office. You are one car sale away from getting your bonus. Money is tight. You're sitting across the table. The person across the table from you really wants that car. You know that the minimum income for the loan is $30,000. The person says they make $25,000. Who's it going to hurt if you just write 30 into the computer? You know the bank's not going to check it. You know that the customer sitting across from you is going to be happy that day. And you know that there's no verification, right? So we're creating unnatural incentives where this stuff can happen. And then the third big leading indicator is, are we seeing the products being offered adjust to reflect the reality that people actually can't afford what they're buying? And if you look at the mortgage space, that sort of reflection happened with teaser rates, all kinds of stuff to make the first few payments affordable, whether that's for 12 months, 2 years, 5 years, whatever. And then the day of reckoning comes. We haven't quite gotten there yet. I haven't seen discount arm auto loans, but just give us time. But I do see the extension of terms to 6, 7, and sometimes some folks maybe even thinking longer than that, but 6 and 7 predominantly. That is really just a way of forcing payments down to help people get a loan. And again, in our survey, 83% of people took out a longer term because they wanted to lower the payment. That was just flat out. We went out and we asked them, why did you take a 7-year loan? Couldn't have afforded it otherwise, because in their mind, afford equals monthly payment. So those are the leading indicators. So in my mind, if you think about that person sitting in a bank branch originating loans to what we have today, you have someone who is sitting in an auto lot who is paid on incentives for booking as big a loan as possible and as many of them as possible with no skin in the game, sending them with understanding the rules and being able to play with those rules, potentially fraud at worst, and products becoming increasingly liberal. And then if you look at the back end in terms of what we're seeing in terms of performance, I mean, I meet people all the time who are, walk away with buyer's regret, spend too much for a car, it breaks down, they try to sell it, can't sell it, so you start to see that anecdotal data, but you only need to look at some of the securitizations of subprime players to see, real defaults. But I think the bigger thing is look at folks like Santander, who's not afraid of subprime auto, right, at all. But they're saying, whoa, right? We don't like what we're being forced to do, because remember, these guys have to compete in the dealer against everyone else, and it goes to the lowest common denominator. So if there's a really crazy, thinly capitalized, originate, securitize, distribute player out there that's saying 7 years, no FICO, no documentation, I'll fund you today, it makes it impossible for more responsible actors to participate. And that's what we're seeing now. And so I think that even bigger than securitization default data is when you see players who are comfortable in subprime historically pulling back, that means there's some really crazy stuff going on.
Perfect. And Rebecca, continuing on this theme, what are you seeing on the ground developing in terms of the numbers that you look at, the data that you look at?
Well, one thing that I look at certainly is those extended loans, but we also have to keep in mind that not all 72-month loans are bad. For instance, if you have 0% financing, it kind of makes sense to have a 72-month, you're not paying anything, you can pay off other debt, you have an opportunity to have your money there, and maybe you're not, and so I think we need to be careful when we say all 72-month loans are bad. Also-
72-month subprime.
Oh, 72-month subprime, again, if it's 0% financing,
But who's gonna give us subprime loan 0%?
well, it depends on what the interest rate is then for it, and we certainly do need to be careful. The other thing, and on used cars, that's a whole different thing as well. So I think it depends on, we have to make sure that we're talking how we're defining what these loan terms are before we get too hysterical on these kinds of things. When I look at some, Manheim Consulting is part of Cox Automotive, which is part of Kelley Blue Book, and so they were kind enough to share some information with me. One of the things that I definitely have concerns about is the number of repossessions. They are increasing. Auto sales are increasing as well. Last year we had a record year, so as a percentage of the market, they are not in dangerous territory yet, but it's certainly something that we want to keep an eye on for sure. From a consumer perspective, I too go in with my parents and brothers and sisters to help them buy a car, which is always entertaining. Since I'm usually not the person they address, they usually address the male that I'm with. But one of the things that we need to keep in mind is that it's so important, and we've been saying this for years, that you need to shop by MSRP. What are you actually paying for the car? Don't shop by payment. And that is something that is so hard to do because the dealer, as Nick said, is solely focused on saying, this is the payment. And it's about, yes, but what is the actual amount that I'm paying for the car? And that's where a place like Kelley Blue Book can come in handy, and our sister companies like Auto Trader, and help you know before you go into the dealership what you should be paying for that car, so that you don't overspend, so that you don't go in there and don't really know what you're doing, and so it's incumbent upon consumers to educate themselves before they go into the dealership, before they go into the hot and sweaty F&I room in the back, where you just want the car. So I think we've got to get the consumer educated and show them places where they can go to get that kind of education.
And John, obviously you have a different perspective here. I'm curious, we have in the data book that we have here, complaints dramatically increasing at the CFPB when it comes to auto loans. We've done a fair amount of investigating into complaints about debt collection and fees and things like that. What are you seeing in this market right now? Complaints at the consumer level or otherwise the health of the consumer when they're buying cars.
Sure, and so I do think you're correct that obviously a lot of the practices that Nick described, that Joe described, we're definitely seeing the result of that is oftentimes complaints certainly from consumers. I wanted to take a step back to think a little bit about when we're thinking about what's going on in the market right now. I think it's really important to emphasize some of the things that Nick pointed out, that the customer of the finance companies, whether they're banks or credit unions or whoever, and I think it's actually like maybe 75% or so of folks that actually finance at the dealership, take out cash sales altogether. The customer for the finance company is the dealer, and so the entity that they have to entice to, as he points out, send them volume are the dealers, and the way they do that is to allow a higher markup of the interest rate, allow a higher LTV, allow higher cost vehicle service contracts, add-ons, all sorts of things, much of which is against the finance company's interests, truthfully. They know, we did litigation 15 years ago that involved 75% of the auto market reaching settlements regarding dealer markups. And we saw, and finance companies told us, we don't like these things. These things, we know they increase our default rates, they don't help us, but we have to do it if we're going to get the market share. And so during the recession and immediately thereafter, we actually saw a lot tighter credit, and we saw finance companies able to tighten up on some of these things that they have to use to incentivize dealers to send new business. And for a while, we actually saw dealer profits greater on the sale of the iron, the cars. They were making more money selling cars than they were selling financing for a brief period of time. Now, last year, we went back to the more traditional. Car dealers typically sell financing, and they kind of sell cars on the side. They make more of their money selling financing, they make more of their money doing servicing than they do selling cars. They make more money selling used cars than new cars. And when we've got that kind of market, it ends up being really horrible for consumers. I think it's important to when we think about the scale of this problem. So a lot of people think about, consumer credit. We look at, mortgage is about $8 trillion right now. Student loans, 1.2, 1.3 trillion, something like that. Cars, it's a little bit over $1 trillion now. That tells you one side of the story. We're just looking at numbers of dollars. But we need to look at the number of people involved. As we talked about earlier, the people that are actually affected by this, it's huge. As Joe pointed out, a lot more people own cars than houses. We've got about 28 million auto originations every year, compared to about a little bit less than 8 million mortgage originations. And a large percentage of that are these subprime auto loans. Now, I do a lot of work. We've got a project, Working Cars for Working Families. We want to see people be able to get and keep a reliable car at fair terms. We don't have any problem with extending credit to a lot of people. A lot of people can afford a car, and it's going to be really important for them to be able to get to work and everything else. But when the average interest rate, when we look at how low interest rates actually are, how low the cost of funds are right now, the average interest rate on a used car for subprime is 15% for subprime, 20% for deep subprime. Much of this is not risk-based pricing. It's truly opportunity-based pricing. We see a lot of finance companies that what they do is just max out whatever the usury rate is in their state, and that's what they're charging. That has huge implications, even if we don't see an increase in defaults, in terms of what that does to consumers, in terms of negative equity when they try to buy another car, in terms of what it's costing them day to day. And as we pointed out, we used to work with, I work with a number of nonprofits that provide cars for low-income families at no or low cost. And we were actually in a fair amount of discussion with some employers prior to the recession because they saw a lack of access to reliable transportation at fair terms as a real hindrance in getting good employees. The recession changed a lot of that, but of course now we are actually seeing unemployment numbers going back down. My expectation is we're going to see employers looking for good employees, and when, as was pointed out earlier, you can't drive your house to work, you can live in your car. But as people either have their car repossessed or a long-term loan that outlives the life of the car, suddenly don't have access to reliable transportation to get to work, that has a lot of detrimental impacts on our economy beyond just that consumer that's being affected.
How much, I'm curious, what the percentage of subprime for auto loan origination, because we're showing a really low number, and so, and you had mentioned that a large percentage of that.
Right, so if we look at, if we look at, forget whether it's Experian or Equifax, they're non-prime, right, well, they use obviously different definitions of
Right.
prime. They're non-prime, subprime, and deep prime is 30% of the market, which is pretty big. If we look at just what's Equifax defines as high-risk borrowers, in the fourth quarter of 2015, there were 1.5 million auto loans originated. There were just 100,000 mortgage originated during that same period. So it's really huge.
Yeah, we have on page 10 of the data book, I think total loan or auto loan origination by credit score, 2015, 22.8% below 620, 13.2% between 620 and 659.
And the horrible thing is, those folks that can least afford it are subsidizing things for all the rest of us. I mean, in the markup area, the people that get the incentive 0% financing are the ones who need it the least. The people that are right on the edge of whether or not they're going to be able to keep making this car payment throughout the life of the loan are the ones that are getting marked up the most. And it's the same thing with...
Same thing as credit card.
Yeah.
0% teasers funded by
Right.
interest rate rollers.
It's the same thing with add-ons. We see right now, it depends on who you talk to, but dealers say somewhere around $1,100 to $1,500 per unit per car in profits on the F&I side, much of which is the sale of these add-ons. And by the way, these are, I see examples where on the same day in the same dealership, one customer is charged $47 for window etching, and the customer is charged over $1,000 for window etching. These things literally, when the finance company goes to repossess, have no value. Some customers, and typically those who can least afford it, are the ones who are paying the most for these things, and who are really being targeted for the sale of most of these items. And they're really subsidizing things for the rest of us, because like I say, dealers make more of their profit on the F&I side than they do on the sale of cars.
I want to talk quickly, and then we'll open up to questions. Two things we've seen, I think, in our work, that credit is flowing to subprime borrowers. Credit is available to the point where you have a car that has 72-month loan that's got 120,000 miles on it. 2 years in, 1 year in, you're turning it back in, getting another car, right? Even if you are underwater on the payments. So, what are the examples? What are you all seeing about credit? The availability of credit. And then the second piece of this is, it seems also very important for this market to remain going as it is, that used car prices remain high. I think we've got, how long is that sustainable in your view, that used car prices will remain high? And what should we be on the lookout for if credit continuing to flow and used car prices remaining high is essential to this market functioning the way that it has developed? What should we be looking for in terms of either of those things stopping, and why might that happen? Maybe Nick, if you want to kick things off.
When I look at the used, or the subprime in particular, auto financing boom post 2008, I think there's the danger of a single data point. When people willingly walked away from their mortgages after the Great Recession, but continued to pay on their auto loans, you had an entire industry of Wall Street salespeople who could come up and say, look, even in the world's worst downturn, people still pay their auto loans. This is safe stuff. And we were still in a world of 0% interest rates. You had investors looking for yield. And now you could have someone who says, look, through the worst downturn ever, people kept paying, and I can give you 15% interest. This stuff is beautiful. And then they just started selling it, right? And I think the real issue is a single data point. The reason people were walking away from their homes is because they were so dramatically underwater. That was a very unique circumstance in the last, 100 years. So I don't think we should be reading too much into that. But that just started churning out the paper that investors were happily buying. The difference is it's not going to take too terribly long, because as the underwriting standards continue to get looser and these early vintages continue to deteriorate, at a certain point, the music will stop. And I think anytime you look at an asset class, when credit is made available, prices of that, when credit is made available to purchase an asset, the price of that asset tends to go up, right? And I think we're in an environment right now where there is plenty of credit available to buy used cars at silly prices at a certain point, and it's all a question of timing, who knows when, but at a certain point, defaults will come through too high, investors will get too nervous, and institutional investors tend to run in herds. So right now they're buying. At a certain point, they will stop. And when they stop, you will see a lot less credit available to make used car purchases. You'll see a lot of people stuck in underwater subprime auto loans, and the prices will come dramatically down at that point in time. And in my own mind, that much is obvious. What I can't predict, unfortunately, is when that will happen, and when the herd of institutional investors will start to head for the exits.
I think the market, though, the reason that used cars were so expensive was because there weren't very many of them. Because in 2009 and 10, we had terrible auto sales, so new cars were not being sold. We were down to 10 million units a year. So as the markets recovered, we did 17.4 million last year. There are going to be, the supply of used cars will increase, which will hopefully help some of the pricing there. Demand obviously will increase as well, but hopefully with more supply. We're also seeing an increase in leasing, which gets back to the affordability issue, whether, you know, people will buy a car that they can't really afford, so let's lease it instead. But that also drives availability of used cars. So hopefully we will start to see more used cars come into the market and potentially lower the pricing on that a little bit, because we were just the market itself was just incredibly constrained. 10 million units is such an incredibly low number. I remember when we were looking at that forecast and I thought, this can't be right, because I was, you know, we were used to 15, 16, 17 million. It just didn't even seem feasible that we were looking at 10 million units, and yet there we were. Now we're looking at 17.4 million units, which is almost overinflated, except when you look at how constrained the market was in the last few years, and there is an amount of pent-up demand. We've got a park, or the vehicles on the road are about 11 and a half years old, so we've got a lot of old cars out there that need to be replaced. So some of these numbers, when we're looking at them from an economic standpoint, again, I'm looking at this thinking, these are pretty viable numbers. It's not sustainable. We will see a decline in sales over the next couple of years, but that, again, is okay. That's what the market is supposed to do. What we saw from, say, like 1999 through 2006 was not natural. That's not what we want to see. That was a lot of new cars coming onto the market, fueled by overproduction, fueled by too many plants, fueled by really bloated manufacturers. So we've trimmed a lot of that. It's a much more lean, mean industry. And now we've got sustainable and profitable manufacturers. Wall Street still hates GM, Ford, and Chrysler, but it is still a profitable, you know, they are starting to make profits, and they have lowered a lot of their bloated plants and their workforces and such. So I think we need to look at these market forces when we think about what we're seeing. Subprime is definitely a huge concern, but again, we've got to emphasize to these consumers, you've got to educate yourself, you've got to resist. You have to go in and know how much etching should cost, know how much these things should cost. And it's really hard to do, but to get in there and say, this is what I'm paying, this is it, I'm sticking to it. I recently heard a really interesting fact about mortgages and how you really actually should only buy a house that requires a 15-year mortgage. 30 years is just too long in today's day and age. They really should have the discipline to go in and buy a 15-year mortgage. Houses are way too expensive. I live in Greenwich, Connecticut. Getting a 15-year mortgage is impossible unless you want to live in a studio. You know, but it's something to think about, to go in with that mindset. And that's what I'd like to educate consumers and say, go in with the mindset of a 48 or 60-month loan. Go in with the mindset, go in with the educations. Why I love working for Kelley Blue Book. It's a consumer website that educates consumers. We provide research for consumers so that you can go in there with a good idea of what you should be spending, and go in there with the education that you need.
John, right before you pick up here, two of the points you made, Rebecca, actually kind of caused me a little bit of worry, which is that if used car prices go down, that will affect the financing, and if you have this sudden supply coming online from, you know, new car sales and leases rolling off, all of a sudden, yeah, prices are going to go down, but as we mentioned before, that means the financiers are going to be that much more inclined to want to repo the car even sooner, to repo the car even faster, because, you know, the worry that the car won't be worth as much if they let you keep it another 30 days, 60 days, 90 days. I mean, since we've already seen these repos going up. I mean, so I don't want to be too imaginative here, but is that supply coming online and those prices going down potentially something that could precipitate this auto, financing worries that Nick was just talking about, that the music might stop?
No, I think that there's still enough demand out there. And you know, we've got a huge population bubble in the millennials coming on board. And there's a lot of controversy and discussion whether they actually want to buy cars and this and that. But they do, and we're seeing it. And our surveys that we run at Cox Automotive certainly supports that. So I think that demand, I think there's enough healthy demand. You know, millennials number 80 million. For people born between 1979 and through the 90s. So we've got a huge bubble of opportunity there. Even if they buy at a lower rate than their baby boomers or Gen Xers, I think we still have a healthy amount of demand that's coming on board. And I don't know that we're gonna be seeing significant declines in used car prices just because we've got more supply, because we do have the demand there as well.
Okay, all right, perfect.
Do
John?
you agree with that? Do you think?
Yeah, I mean, I'd just add one other point, which is around repossessions. I mean, given that automobiles are depreciating assets, lenders generally don't make money when they repossess a car. I mean, if you think about the housing market when house prices were going up, if you repossess or foreclose on an appreciating asset and you go out and sell it, you almost ironically, in a rapidly appreciating market, the less efficient you are, the more the home is worth by the time you ultimately get it. So you're sort of in this perverse world where you feel like, okay, even if they can't pay, I'm gonna make it. But I don't think any lender is under the illusion that an automobile is an appreciating asset. It is depreciating. It is depreciating rapidly, especially if you're in the used car space. And so these guys making the 15% loans, 15% interest rate loans, they want their borrowers to pay, but they also realize a really robust and aggressive foreclosure process or a repossession process is important because a lot of these people probably couldn't afford the loan to begin with. So you need to shout loudly and frequently, and you need to have, I didn't even know they were turning off cars, that's pretty impressive, but that type of stuff so that if someone only has a few $100s, what the lender wants is that few $100s goes to them first before any other bill. So I don't see sort of lenders opportunistically foreclosing on cars to make more money. I just see the aggressive foreclosure policies, especially when a borrower can't afford the loan, is to make sure that lender gets the money first.
Well, and let's move to John, because I actually, we've done a fair amount of digging on this, and you're making a 150%, the LTVs are 150%, the used car prices are high, and you can sell right away, and you've got all these upfront fees. I think that changes the economics of your decision on whether or not you can make money. I know there are certain, we've dug into a couple of these financing companies that precisely make more money by taking a car, selling it, having some fees up front, then selling it right again very quickly. Especially when you can sell all these old vehicles that historically would have been scrappage otherwise. So I think I'm very interested in this precisely because of some of that work that we've done.
So I might be able to shed some light on that. So
Perfect.
it's important to realize that there are very different players in this market, even within the subprime or whatever. We've got not a small number, a lot of pretty good size, relatively speaking, finance companies that really operate much differently than the sort of traditional market. They buy these retail installment sales contracts at a discount. They're paying 80% of the face value of the retail installment sales contract. They do very well when they repossess, even with a higher LTV. That's where we see especially the use of the electronic repossession devices, the automatic kill switches and remote kills, but also the use of GPS tracking and the use of license plate recognition technology. We did a report a few years back called Repo Madness, looking at the number of people injured and killed every year, the number of young children in vehicles when cars are being repossessed. I mean, it's a crazy thing that even we have examples where it was a car that actually wasn't up for repossession. We weren't in default or anything. It was just the same color, the same model, with the minor children in the back seat when it got hooked up to the tow truck and pulled away. So I mean, this is something that affects us all, and it's a very unusual sort of way of retaking property. Actually, it's weird. It goes back to the Middle Ages that they allowed self-help repossession when we had such limited ability on the government to actually take care of these things that they allowed this. It's gone away everywhere else. We don't allow self-help eviction anymore, all those sorts of other things. But this is really the last kind of bastion of this, taking enforcement into your own hands, and it's really dangerous. So that model varies, whether or not the repo is good. Actually, if you're buying it, if you're a more traditional finance company, you are going to really get hurt when you're repoing, even if you haven't seen a drop in the value of the car. Obviously there are a lot of costs tied up with this. And so they generally don't want to repo. They want this as kind of like a threat, a cudgel over the consumer's head to use. There was a bankruptcy decision that was really interesting, looking at some of the electronic repossession devices that likened it to the doomsday device in Dr. Strangelove. It's this really kind of just scary thing hanging over your head. But I think it is important to look back at what's happening with, the value of cars. We looked at LTVs and subprime. I'm not sure I'm quite as confident about what's going to happen with values going forward. We had both cash for clunkers and really low sale of new units and all that. Suddenly we've got a lot of cars coming off lease, and that's about a third of the finance market right now. Much longer terms, and these things, it's not just that it's a depreciating asset. People are way upside down day one when they walk off the lot, and it's 150% LTV. And then if you're in a 60-month, 72-month financing for a used car, there's going to be there's already a lot of negative equity walking around, but going forward, I think it's going to matter both for the auto market and for us in general. There's going to be more folks coming in with either a car that doesn't run anymore, that's, there's a huge amount of negative equity, or even if it does still run, but not very well. When you have a 60-month, 72-month loan at 150% LTV at a 20% interest rate, that's going to be bad. Yeah, it's going to be troublesome. And it's not, we talked earlier about credit is flowing. This isn't a result of the fact that credit's available. This is a result of the fact that the competition for that credit is competition for dealers. So all the incentives are unfortunately bad incentives for the consumer, and ultimately for a lot of the finance companies as well. The availability of credit would be great if we had a market where it's people competing for the consumer's business on fair and transparent manner, but that's unfortunately not what we're looking at right now.
I have a million more questions, but I think it might make sense to open things up quickly to the audience for questions. Do we have any questions here?
Yeah, John, you talked about finance companies that are still making money even when the car is repossessed. A lot of times what we see is the consumer owes a lot more on the car than it's worth.
Yep.
So it's not over for the consumer, they're then sued for the remainder. Do you think that all of the sales of these cars, whether they're auction or private sales, do you think they're all bona fide?
I'm sure they're not. I mean, obviously, especially there again, it's sort of a continuum. If you look at the buy here, a lot of the buy here, pay here dealers. I personally, when I was at Legal Aid, had a client come in who bought a car at a buy here, pay here dealer, who fortunately made it into our office before her car was repossessed. We found 7 other retail installment sales contracts in the glove box for that same car within the past, I think it was 5 months. They clearly were not, this arm's length transaction, and it varies, whether or not are they actively pursuing this, the deficiency on those repossessions. Things have changed in terms of, the market for this debt, and so now what we are seeing with a lot of finance companies, whether they're keeping it in-house or selling it, much more active and oftentimes abusive collection efforts on these deficiencies, which can stick with people for 10, 20 years, depending on what state you're in. And obviously it's going to have a huge impact on their ability to get financing for a car or do all sorts of other things going forward. They're using, their ability to get employment, all kinds of things like that. I don't know if that entirely answered your question. I think I got maybe a little off track, but yeah, we see a variety. So we see some where, the buy here, pay here ones that there is no chance. Even the ones that are allegedly considered commercially reasonable, if it's a dealer-only auction, and depending on, it might be the most efficient way from the finance company's perspective of disposing of this unit, but it doesn't necessarily mean it's going to realize the best price for, ultimately for the consumer to try to knock down a fair bit of that amount that they still owe to the finance company.
Other questions?
Do you see any differences between states? Or do some states do a better job of regulating this industry? What do they do well and what?
There's a huge difference, and it varies. If we look at the car side, there are a number of states that have, one way or another, some protections in place regarding the the car's roadworthiness, whether or not they require, or even just maybe prohibit the dealer from disclaiming implied warranties when they sell the car, all sorts of things like that. On the financing side, I mentioned earlier, we've got a lot of finance companies that are not using risk-based pricing, but instead just max out whatever the usury rate is in their state, every single finance deal, and that varies greatly from state to state, some of which have different rates based upon the age of the car or the amount financed, and obviously just in terms of absolute numbers, those permissible interest rates vary a lot. We've got a lot of difference in states in the way that they protect consumers during the repossession process. Do they have a right to cure prior to repossession? Are there required licensure for the repossessing agents? All sorts of things. There's a huge variation from state to state in all manner of these transactions in terms of how well they're regulated.
Nick, you mentioned that dealers are making loans, no FICO, no documentation, half the loans aren't verified. I never heard that before. Do you have a site for that?
Yeah, so I mean, in terms of no FICO, you can just look at the securitization trusts of what are the requirements. I mean, there are a number of specialty finance companies out there that will have low and no FICO requirements. And so it's not the dealer making the loan, it is ultimately the finance company that thinks it can either sell it or retain it, and there are low and no FICO options out there. In terms of verification, we did a national survey, we used Google Consumer Surveys, we went out to people and said, have you financed an automobile in the last year? And then we asked them, were you asked to provide income verification during that process? And over half of them, whatever the number was, 52% said they were never asked for income verification when they were buying. So this was, granted, it was a Google Internet Consumer Survey that we did. So it's nothing more scientific than that. But I can also speak anecdotally. When I took Mom to the shop, and this is why I went out and did the survey, they were offering her credit, and so I asked, and I said, but do I need to go home and get pay slips and things like that? And they said, no, don't worry about that. So I assumed that she probably wasn't the only one who was given that offer.
But is it possible they didn't ask for that because having your name, your social security number, they could run all those financials and
So I think
your score?
Yeah, I think that's the biggest myth is that with a credit score you can understand someone's income. In the credit bureau you do not have income, right? In the credit bureau you have what have you borrowed and what monthly payments have you made and some other judgments and things like that. But you don't have income. There are certainly analytical models that have been built which predict your income, but those tend to break down much more dramatically as you go into higher risk subprime segments. So I mean, for example, if someone is a 770 FICO and every month they're paying off $10,000 worth of credit card balances on time every month, you can probably impute that person's making much more than $10,000 a month with a high level of accuracy. But when you start to get into the 550 FICO range, lots of missed payments, sloppy behavior, to try to impute how much does that person actually make on a monthly basis, it actually becomes a lot more difficult. Just as a thought, when you're getting a mortgage, there's a cooling off period between getting your documentation and then actually having to buy. And it's a lot easier to get income documentation when there's a process, there's cooling off period, there's time to do things. Because everything is pressured on, again, if you think about what someone on an auto dealer lot is told, don't let them walk off the lot without a car, right? And to a certain extent, this is just more conversational from my industry days. Dealers would be happier to make a little bit less money on a loan from someone who has much more relaxed verification criteria. They know that they can get it through and get it approved, right? Because yes, they have dealer markup requirements, but if they know that maybe they'll make a little bit less on this loan, but no verification requirements, and they can get this thing booked, the dealer finance guy's gonna go after that in a big way.
I guess, we have one more question?
Yeah, Nick, you mentioned that there's a race to the bottom as far as dealers looking for lenders with the easier terms and things like that, and that there's a big gap as far as the incentives for lenders not being in line with what dealers are looking feel like that can change only through regulation as far as going forward? Is there something in the market that can kind of realign those incentives?
Yeah, I mean, I think I still have colleagues who work rather frustratingly in large banks trying to find ways of getting loan volume through dealer relationships. And I think as long as there are no rules and no minimum standards, and then there are actors out there that are willing to say 550 FICO, no income verification, I'll fund it today. It's going to be very difficult for a traditional finance company to ask for income documents, because it's one thing to think about trade-offs where someone looks on a rate table online, they're trading things off, and if you lose here but win there, maybe you lose a little bit of volume. It really does become almost all or nothing in these dealers, because if the dealer finance guy sitting in the back knows, or gal, a woman, man or woman sitting in the back knows that this finance provider is gonna get it done the quickest, fastest, easiest, that person's gonna start moving all of their volume to that provider. And that also helps with, you talk about pushing the state max in terms of interest rates. It's a lot easier to give everyone the same rate when you're sitting in a dark room at the back of a lot at the end of a shopping process and someone's just pushing this stuff onto you. So I mean, I think the dealer is really, and really at the center of it, and unless there are rules telling the dealer, cool-off period is personally my favorite, right? Cool-off period, and below certain FICO scores, there needs to be income verification. I mean, I think that with affordability, because it's, as soon as you eliminate stated income, and as soon as you give a cool-off period so that someone can step back and use Kelley Blue Book and do the research and think about things, right? But as long as there's, you get it that minute, it's tough.
But a lot of consumers don't want to leave the lot without a car either. I mean, we see this all the time. People want to buy the car that's right there, standing right in front of them, and
They want a house today too.
no, they do. But I mean, it's we also have a situation where the consumer says, "I'll do anything that I need to do." I really like the idea of income verification with the credit, combined with the credit score. But again, that also means changing the mindset to say, when you go to buy a car, you've got to have all of these things in place. People know when you go to, trying to get a mortgage these days is incredibly laborious. And you need to go through all of these things. So I think that there's opportunity for improvements in the process, but we also have a situation, in Germany, they don't have car inventory. You order your car and you wait weeks to get it. Here, it's like, what do you mean I can't have a car today? They have DMV runners that can go and get that car and insurance, and everything is all done really, really quickly. So there needs to be a cooling off period on both sides of the equation there.
One last question?
Yeah, I've heard a lot today about the competitiveness of the market and this, race to the bottom with the incentives favoring dealers. But I was under the impression that a lot of the financing is going through captive finance companies. So if you're a Ford dealership, everything goes first to the Ford, finance company, or same with Chrysler, and that they had a lot of control over the interest rates and the financing terms. So can somebody talk about the interplay between those two trends?
Maybe just a quick clarification for me. I have no issues with Ford giving 0% to super prime people, right? And so if we talk about the 750 person walking onto a lot in Ford or Mercedes or whomever says, here's 0% financing, fantastic, right? It's an incentive for people. They can go out, they can get 0% financing. That's great. The area that I'm really focused on is the subprime, high interest rate, used car. That's the segment that bothers me, which is the percentage we're talking about.
Right, and I think that we're also talking about more of like the corner lot. We're not talking about the Ford sponsored or the dealerships that are working hand in glove with the manufacturers. So I think it's a little bit different market when we're looking at subprime. I do think that it's much more difficult to go into your local Ford dealership or a Chevy dealership with subprime. I think that we are going to have different standards when we're talking about captive finance companies for sure. Volkswagen makes most of its money off of its captive finance. To your point, John, that so I think it's a different market. It's a different segment of the market that we're talking about. I used to work for Mercedes-Benz Credit, and we obviously had very, very famous people on, on the books all the time. Even some of them got repoed because their agent didn't manage their money well. And we got letters that said things like, I've lost everything, but I still have my Mercedes. Please let me keep my Mercedes. So I think that even captive finance companies can get into trouble with this. But I think where the guidance needs to really be is at that true subprime and what did you call it, deep prime, really, really bad people? It's kind of
Well, no, so the people oftentimes are very good, obviously. But I would disagree on the fact that, this assertion that this doesn't happen at the franchise dealer down the block. We see an awful lot of this. Franchise dealers actually make more of their money on the folks who are being sold to subprime financing.
My understanding is she was talking about captive finance companies.
Yes, but I'm saying, you were saying that it doesn't happen at the Ford dealer down the street, but it happens at the Ford dealer. They may or may not be using the captive creditor, but it's happening at that dealership.
That's the link that I was making between what she was talking about. My understanding was your question was the captive finance companies and their behavior.
No, well, I think the question is that policing, is that preventing, are those captive financing?
And even the captive financing, I do want to say, a lot of that 0% financing is, a real come on, but when you get on the lot, you don't wind up with the 0% financing. A few of us do, but many don't. And that becomes much more expensive for those who are kind of, led into this on that kind of pretext. Yeah.
All right, well, I have more questions, but we've got to wrap things up, so please give our panelists a big round of applause.